All right, let's dive straight into what is shaping up to be a massive structural shift hitting global capital markets. We're talking about a historic alignment here in 2026. SpaceX, OpenAI, and Anthropic all stepping onto the public stage at the exact same time. In this explainer, we're going to map out exactly how this unprecedented event is permanently reshaping the actual plumbing of the financial system. It's moving vast pools of capital and, as you'll see, creating intense ripple effects across the entire tech sector. To really wrap our heads around the sheer scale of what we're looking at, we have to start with this staggering number, $4 trillion. That's the combined target market capitalization of SpaceX, OpenAI, and Anthropic as they enter the public markets. To put that into perspective, the potential demand from these listings combined easily exceeds the entire 2025 US IPO market by up to 4 times. So this isn't just a big news week for tech, it's a seismic event that's literally forcing every institutional portfolio manager in the world to make an active allocation decision. Industry analysts are calling this a structural inflection point in global capital markets, and they've hit the nail on the head. This is a fundamental test of public equity demand capacity with absolutely zero modern precedent. I mean, we're talking about incredibly mature private giants transitioning to public markets. They already have established corporate infrastructures, massive revenue pipelines, complex governance structures, and they are all demanding a massive slice of the pie at the exact same time. Now, just a quick heads up before we map out these market ripple effects and figure out who wins and who loses in this capital rotation. We are neutrally exploring the mechanics of these events based on market data and analyst reports. So this explainer is strictly for informational and educational purposes only. It is absolutely not financial or investment advice. Keep that in mind. All right, moving into section 1, the trillion-dollar IPO wave. Let's look at our first core catalyst and see how this historic wave is actually building. We've got 3 vastly different companies, all commanding just mind-bending valuations, hitting the market simultaneously. First up, SpaceX. They're targeting a valuation of up to $1.77 trillion, executing a massive $75 billion raise on $18.7 billion in 2025 revenue. Then we have Anthropic, targeting around a $1 trillion valuation, and they're armed with an incredible $44 billion annualized revenue run rate that's heavily driven by their enterprise clients. And finally, OpenAI. They're also eyeing that $1 trillion mark, generating a $24 billion run rate, but, and this is a big but, they're simultaneously burning through $14 billion annually in operating costs. The sheer size of these offerings requires a monumental amount of cash to just be absorbed by the market. That brings us to section 2, the fast-track index effect. So what's the structural mechanic that turns these massive IPOs from, optional investments into mandatory market events? It's called the NASDAQ Fast Entry Rule. Because of this newly implemented rule, index funds don't have the luxury of just sitting back and waiting to see how these companies perform over their first year. If a mega-cap IPO lands among the 40 largest components by market cap, which SpaceX, OpenAI, and Anthropic easily do, for sure, they can be added to the NASDAQ 100 within just 15 trading days. That means passive index funds, which make up a huge portion of the market, become forced buyers almost immediately. The crucial takeaway here is this 4-step mechanical sequence. First, the mega IPO lists. Second, it hits that top 40 market cap, which engages the fast-track mechanism. Third, within 15 days, it's in the core indices. And fourth, passive index funds are forced to buy the new stock to reflect its weight in the index. Because passive funds don't exercise subjective judgment, they literally just replicate the index. This sequence directly and automatically siphons capital away from existing stocks to fund these new entrants. It's totally mechanical. And that leads us right into section 3, the great liquidity drain. When forced buying happens on this kind of scale, well, the money has to come from somewhere, right? And that creates immediate losers. JP Morgan estimates that a staggering $95 billion must be forcibly sold off by passive funds just to make room for SpaceX's massive index weight alone. Think about that. That's $95 billion in sell orders, hitting the market solely to reallocate capital and accommodate just one new listing. And that's before we even talk about the subsequent listings of Anthropic and OpenAI. This whole phenomenon is what's known as the siphon effect. Look, capital is finite. It's a zero-sum game in many ways. That means every single dollar flowing into SpaceX, Anthropic, or OpenAI has to be extracted from somewhere else in the financial ecosystem. Portfolio managers who track global growth or technology benchmarks, they literally must trim their existing core holdings to free up the cash required to subscribe to these new mega IPOs. So this downward pressure really hits 2 distinct groups. First, you have the dominant market leaders, the Magnificent Seven, like NVIDIA, Apple, and Microsoft. Now, for years, they've dominated passive index inflows, but now they face structural dilution and forced selling to make room for the new giants. Second, we see deep tech and space peers, companies like Rocket Lab and Intuitive Machines. Actually, when SpaceX clarified its IPO timeline, these adjacent stocks saw sharp intraday drops. Why? Because institutional allocators consolidated their space sector exposure, directly siphoning capital away from the smaller players. But it's not all doom and gloom. Let's look at Section 4, the strategic upward re-rating. Let's flip the coin for a second and see who actually benefits from this massive capital reallocation. Companies with direct equity stakes or exclusive supply contracts with these new IPO issuers are actually experiencing significant upward re-ratings on their own stock prices. On one side, enterprise SaaS companies are realizing multi-billion-dollar non-cash investment gains simply by holding pre-IPO equity in these AI giants. Meanwhile, custom silicon and advanced semiconductor firms are securing massive, multi-year purchase commitments just to build out the required AI infrastructure. These specific alliances show how enterprise adoption and hardware partnerships act as a massive protective moat. Just look at Broadcom and Google securing a huge 5-gigawatt compute capacity agreement with Anthropic. Or consider Salesforce and Zoom. They stand to see massive balance sheet markups from their equity stakes in Anthropic. Microsoft already holds a critical near 27% stake in OpenAI, and Tesla is deepening its Terafab AI chip partnership with SpaceX. These strategic links allow these specific firms to catch the cascading liquidity rather than losing it to the siphon effect. It's a real game changer for them. Now let's zoom out a bit for Section 5, the AI CapEx trap. Looking at the broader macroeconomic view, we absolutely must confront the ultimate systemic risk looming over this entire $4 trillion event, the compute CapEx trap. This is a systemic vulnerability where the exponential spending on data centers, compute capacity, and hardware dramatically outpaces actual near-term software monetization. If enterprise adoption stalls, or, if low-cost AI models like the private Chinese developer DeepSeek, which has already demonstrated very low compute costs, if they commoditize the market, the massive spending underwriting these trillion-dollar valuations simply cannot be justified. There is a really stark divide in how these companies are managing that trap. Anthropic's enterprise-focused strategy is pushing a $44 billion run rate. Because their revenue is growing faster than their compute spending, they are actually on a path to cash flow profitability by 2028. Conversely, OpenAI's massive $14 billion annual cash burn against a $24 billion revenue run rate highlights the severe, high-stakes gamble of this CapEx trap. They are spending approximately $2.20 for every single dollar of revenue earned. That pushes their break-even projections all the way out to 2029 or 2030. So what does this all mean for us? As SpaceX, Anthropic, and OpenAI permanently reshape the plumbing of the global financial system and siphon tens of billions from the old guard, we really have to ask ourselves, is the market funding a sustainable new era that expands the Magnificent Seven into a top 10 of human infrastructure giants? Or, caught in the CapEx trap, are we simply building a $4 trillion house of cards? It's arguably the most critical question in capital markets today, and the answer is absolutely going to define the global economy for the next decade.